Good morning, world. It is Tuesday, October 18th. Let's get into the Lattes with a shot of mortgage knowledge. So, we've got a couple of things to talk about today. A couple of things are related to interest rates, and then just some reminders because now that we're seeing normally loans that were struggling to get approved the last couple of years from sellers, now that the buyers really have a market again and have the strength to bring in less mindset of sellers, less favorable deals. We're seeing a lot more VA, FHA, and USDA loans go through, which is absolutely fantastic. Because one of the other things I want to show you today is a rent versus buy, because the Zumper released their national rent report this morning, and that was from September's data. And year over year across the nation, rents are up 11%. The average one bedroom now is $1,503 a month, and the average two bedroom is $1,845 a month. Can you imagine what younger generations are going through right now, renting homes and trying to save money for the down payment? I mean, FHA, VA, and USDA are amazing programs for them to utilize, but the market has been so dominated with being a seller's market that conventional loans were taking up a big lump of that. So now, as we see those government funded loans rolling through, we want to remember about the property appraisal minimums. So if you need a copy of this report, send me a message and I'll shoot this over to you. But there's actually a list that has the appraisal minimum requirements when you're looking at the house, what things are acceptable, what things are not. And there's only a few huge differences between conventional loans and what we call govie loans. And government loans all use the exact same HUD property standards appraisal scope form. And that's all of the USDA, that is all the VA, and all the FHA use the same form. And some of the big things that they are looking for that are always problematic when they come up is peeling paint. The biggest reason for the peeling paint is asbestos. So they really want to make sure that there's no peeling paint at all. So if your sellers are looking at selling, because now they need to open up to accepting all different types of offers because their options are now more limited, it would be really smart of your sellers to go ahead and fix up any peeling paint that they find. And they need to lay down something on the ground. There can't be any paint chips left behind. It needs to be completely gone so it doesn't impact the environment. But they can just chip that and then they can repaint it so it's nice and clean. Another really big difference between the loan programs is floor coverings. So every floor has subflooring. That is a requirement of any loan program. But under the government loans, floor coverings must be there. So whether it's tile, laminate, carpet, hardwood, anything like that needs to be covering those subfloors. They can't be left bare. Whereas sometimes conventional allows it. It does impact the appraised value. It does show up as deferred maintenance, but it's not a major requirement to move forward. Whereas the government loans, this is a major requirement. So if your clients needed to pull out the carpet because it was all destroyed and all they have left is subflooring, it's not going to pass a government appraisal. So have them go through and put it back in if they're going to even entertain any govie back loan offers. The last thing is stairs. Any stairs that you have that have more than one stair, it needs a handrail. So at the front of the house, if you have a couple of stairs going up to the front porch, it needs a handrail to be installed. If you have stairs going down to the basement, it needs a handrail installed. If you have a patio off of the back of the home and it's a couple inches off the ground, it's going to need railings that are properly secured and handrails if there's any stairs attached to that. So one of the great things that I do with my agents, send me a picture of those items when you're going to do the listing walkthrough, and then I can tell you what things we might need to consider if a buyer does come into that deal with a USDA, VA, or an FHA offer. So I'm going to screen share with you because I want to move on to talking about where interest rates are right now. So this is Mortgage News Daily. This shows you the average interest rates that are out there for all lenders across the United States. And this just got updated this morning. So we had a little bit of a positive adjustment. So on today's rate trend, you can see down here on the right side, it starts telling you about those mortgage bonds, which is this word. This is your universal mortgage bond. And it's showing you which coupon that it's looking at, but it's showing you that today is a little bit more positive, which is a good thing because we've had a rough couple of weeks. It's funny to say, but mortgage bonds are 7.6 times more volatile right now than Bitcoin. And that is saying a lot because we all know how Bitcoin's been. So if you look at a 30-year fix, the average interest rate today is 7.12%. 15-year is 6.33%. 30-year jumbo, you're looking at about 6.08%. The ARMs, and then 30-year FHA and a 30-year VA. So FHA and VA are really close to each other. USDA is pretty close in there too. Um, one thing that I don't think enough people know about is that we've got a new home buyers boot camp kicking off. I'm going to get a link to that so you can send any prospective home buyers that you have to us so we can start them in the boot camp. What I'm going to be doing is a lot different than a lot of lenders do. Typically, most lenders do 1 hour webinar and they just hit clients with a lot of information and overflow their brain. And what we're going to do is a 6-week boot camp diving into each portion of the home buying journey so that they feel really empowered when they're ready to proceed. We're going to be diving into how interest rates work, why interest rates are different from person to person, and the 33 factors that go into those rates. So that's a really great class, and you are more than welcome to join us. We're going to be talking about why on mortgage insurance, I always suggest putting less down. And it's typically because if somebody does have a good interest or a good credit score, putting down less means that they're actually the more stable of a buyer because they have more cash left over to pay off other debts or to have monthly cash flow. So a lot of times I always suggest to clients come in with a lower down payment so that you have more residual cash left over. And then I show them how they can modify their monthly payment to actually pay it off quicker. We're going to be deep diving into their credit journey, understanding how credit works, understanding how to manipulate and modify their credit and fix it, because it does take time. But the more that people understand how credit works, then the more that they can actually start adjusting that and put themselves in a better financial position. We're going to be doing a whole class on VA home buyers. So really diving into understanding their benefits and how it works and that they can have multiple VA loans at the same time. We're going to be doing a whole class on down payment assistance to Washington State Housing, USDA financing, so that way they truly have zero down payment. And a little tidbit about USDA. Did you know, and this doesn't happen too often right now in this market, but let's say the home actually appraises higher than what the client is paying for. Only on a USDA loan can they actually adjust their loan amount to the full appraised value and use that small gap to help cover their own closing costs. So let's say, for example, they bought a house for 250,000, and let's say the appraised value came in at 254. That's only $4,000 difference. Or in any other loan program, that means they got an instant $4,000 boost in value. Under USDA, we could turn around and use that 4,000 and apply it towards the closing costs. So now maybe instead of coming in with $6, $7, $8,000 in closing costs, maybe now they only need to come in with 2, 3, or 4,000. So it gives them an opportunity to keep some of that extra cash in their pocket. So we'll deep dive into USDA, the eligibility and the household income, because it's a lot different of a loan program than anything else. So we'll deep dive into that too. And then our last class on that 6-week boot camp is going to be dissecting closing costs. So that way clients stop falling victim to those calls from other lenders that say they have amazing rates and then they get a sticker shock when it comes to actual origination costs and their loan estimates. So we're really going to start educating them and deep diving into that. So it's going to be a great boot camp. I've created an entire private Facebook group for those clients. So that way we can add more information for them. We can keep them engaged throughout their journey. We can get them more tips and tricks and even do little videos and drop in information for them as we're going through the boot camp. And then we're also going to pair it with sort of guides and homework and workbooks. So it's going to be a whole process. And I think it's actually going to be really great because remember, the first time home buyers that are going to be buying up the mass share homes are the younger millennials, and they really like the education pieces. So I think this is going to really help to engage them and keep them um, comfortable with moving forward. The other thing I want to talk to you about is that 11% rate here. So let me see if you can share one more screen with you here. So, like I told you, that report came out from Zumper, and what they do is every year or every month they show how rents are progressing, and this kind of gives investors an idea of what's happening with rents and shows them what cities are worth getting investment properties and what they could be netting out of them, and it starts giving us an inside look of what our future home buyers are going to be looking at. So if we have 11% increase every year. Let's say the average two bedroom, like it said on the report, was 1845. That means every year they're going to have a 202 a month increase in their payment. So their new rent is going to be here. In 9 years, here's where their new rent's going to be. Isn't that crazy? So you think about it, it's expensive to purchase a home right now, at today's interest rate, but there's going to be an opportunity later for buyers to be able to refinance down to a lower interest rate potentially. And so they're going to be saving money plus having a write off, plus they're going to be creating equity and appreciation for themselves. But on that rental, if it goes up 11% increase every year, it is going to drastically move up what their monthly more payment for rent really looks like. So here is one of the tools that I have that we can always add to any of your um, home listings. So we can do it as that website where we can do a walkthrough of the house. We can talk about the house. We can showcase the house. We include flyers, and then we can include this, which is the rent over own. And it'll show the clients that estimate cash flow in the first year, the average interest rate, which I was using on this house with a 10% down payment. The person with taxes and insurance is looking at about $3,000 a month for a payment, and maybe their payment right now is 2177 for that similar size of apartment. But in 9 years from now, their average rent payment is going to be over 5,000. So in just 4 years, their rent is going to outpace their mortgage monthly payment. They're not going to have tax write-off. They are not going to have appreciation and net gain. So that is a huge cash flow difference that we can help to show them now. And this is at the higher side of the interest rate. We all know from working in this profession, people don't keep their interest rates that long. So even if they had an amazing interest rate a couple of years ago, they might have already refinanced into a slightly higher rate to pay off debt, which they got because of the equity of their house. Or they might have been in that house for a couple of years and then those lower rate environments happened and they reduced their monthly mortgage payments by refinancing or getting rid of mortgage insurance if they have a conventional loan and reducing their monthly output. So this is just showing them worst case scenario. And on a worst case scenario, that house that they purchased today in 9 years should appreciate about 163,000, which even after they pay their 6% closing costs, and they have their initial cash flow for the first 3 years being negative, by year 9, they'll net gain 218,000 between appreciation and equity, minusing out their costs to sell that house. So this is powerful information to share. And this is going to be part of what I talk about in the home buyer boot camp as well. But if you have a listing out right now and you want to deep dive into this, we can create this together and get it out there so that you have some great information on why somebody needs to invest in their future today, because this is fantastic. That cash flow difference, although the monthly payment seem scary, that monthly payment is going to be nothing in a few years when their rent catches up to it. So that is all I have for you. It is Tuesday, so if anything happens with mortgage information, of course, I will send you out a message later. Really, the biggest thing was just that, rates have really just kind of been teeter-tottering just a little bit. No huge ups or downs so far this week, and it was because the UK pulled back that really aggressive incentive program that they were going to give to their fault of the people, but they have a new finance minister that stepped in and she's removed that. So now they are back to just dealing with the economy as it is and not trying to push inflation higher. So that really helps to stabilize our mortgage bonds. So let me know if there's anything I can help you with. Otherwise, I hope you have a fantastic day and we'll talk very soon.